Let's get right to our next guest, who's here to talk markets, banks, inflation, and Fed policy. Bob Diamond, the CEO of Atlas Merchant Capital, former CEO of Barclays, and like all of us, amateur. Well, you're much less amateur than we are about watching the Fed. But I think at the time, 150 to 175 basis points. Did you ever believe what the market thought at that point? I think you said at that point, maybe half that at most.
We talked in January, remember, and it was clearly in the market that it was going to be 150 to more. And my sense at the time was there was far more risk for the Fed, for the chairman of the Fed, to ease rates with the economy as strong as it was. And the worst thing that could happen is an ease. It's a stokes inflation a little bit, and you have to come back in and raise rates. So I did not believe there would be first half rate cuts. I remember telling you in January, maybe toward the end of the year, maybe one. And I think the economy is a little bit softer right now. So I think it's a bit more balanced. But maybe this year, maybe not.
What you said right at the beginning of when we're speaking here was the worst thing that can happen is if they don't continue tightening. It's Stokes market sentiment or whatever, and then they have to. It sounded like you're describing what we've sort of seen, but you're saying no. You're saying that we are seeing some effect to the restrictive policy that will allow them to cut.
I think so. If you look at the second half of last year. So we talked in January. We just had the second half of last year. The economy was a bit stronger than anyone thought. Inflation was a bit lower than anyone thought. And the labor force the labor markets were still really, really tight. So in a way, in January, I'm saying to myself, they actually can't cut. Now look at the first half of this year. I would say for most of us, the economy is a little bit softer than maybe we thought.
Maybe.
Inflation's a little bit higher than maybe we thought. And for the first time, we're seeing a little bit of softness in the labor market. So actually, I think they're in a position right now where they can't raise.
But we are seeing highs everywhere in the indexes and Bitcoin, and I mean, you're sure the economy's slowing, and you're sure the labor market's weakening. I'm not sure, and you're sure inflation's moderating. I don't know if any of those things. I think we have to watch the numbers, and
I think what I feel pretty confident about, which you and I have talked about too, is that if you look at the markets and if you look at the go forward, it's much better with rates at 5% than it was with rates at 0. The abnormal environment was 12, 13, 14 years of 0 to 1% interest rates. And this isn't a big problem.
Why are we rushing to get back? Why are we rushing to get back there? And why do you think Europe will cut before us?
I think both Europe, I think the UK will lead, Europe will be second, and I think they'll both be ahead of the US. Now, to some extent, I think they need it, right? Their economies are have not recovered as well as the U.S. economy. So I think they need that impetus to economic growth a little bit more than we do. I think what's fortunate for Europe is as they've come into the first half of this year, the economy is a little bit stronger than people expected and inflation a little bit lower. So I think they are poised to cut, Joe.
The banks have been breaking out, especially like J.P. Morgan. Why? The yield curve steepening. They're loaning more. What is so positive for the banks? And is there anything on the horizon, commercial real estate, and anything that is disturbing?
There's a lot of things, particularly in the portfolios, and you mentioned commercial real estate. But if you kind of zero base it on banks, and obviously J.P. Morgan's performing well, but let's look at the 4,500 banks in the U.S., just those banks.
Right now, all 4,500?
4,500. And we're going to see consolidation.
But let's just summarize, so we can't do them all. But go ahead.
We're definitely going to consolidate.
Really?
No question. But let's just say there's a strong bank that's feeling good today. They've weathered the interest rate. They've weathered the commercial real estate. And all they're doing is saying, we're strong today. What's the go forward? Well, forget advisory, because people talk about advisory as being the litmus test for banks. The real litmus test is, for those banks that take deposits and make loans, what's the go forward? Interest rates at 5 or 5.5% are fantastic for banks, far better than 0% interest rates. The next move is likely to be lower, not higher. That's great for banks. And there is probably as much demand for lending as there has been in a couple of years. So the go forward for core banking, I think the go-forward market opportunity and market environment is pretty good.